You've probably heard the word recession and bear market being tossed around like a rugby ball at a Springbok training camp. And just like a good buck captain, you need a game plan. So let's talk about investing South African style, whether it be aggressive, moderate, or the kind that sleeps with the torchlight by the bedside every night. Hi, my name is Yolanda. I'm a wealth advisor. It is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage your money well, to live abundantly, and build generational wealth. I am the founder of this platform, Financially Fabulous Females. I'm also the director of Solomon Wealth. We are a boutique wealth management firm based in Durban, South Africa, and we work with South Africans all across the country, even expat South Africans, get their money right. If you would like to chat to me one-on-one on anything that you hear this video that you could implement in your financial plan, or if you're looking for something new, click the link where you're watching this video or go to my website. It's solomonwealth.co.za. Click on the Get Started button and you can book a complimentary appointment with me. So a bear market, well, it's not a safari gone wrong, that's for sure. It happens when the stock market drops by more than 20% from its highs. It's called a bear market because when a bear claws, it claws downwards. And a bull market, when things are going up, it's called a bull market because when a bull charges, it charges in an upward direction. So if you never understood the bulls and the bears before, that's a quick explanation. Bear markets show up when things start to feel like the government's budget speech, depressing, uncertain. I'm probably not going to help you anytime soon. It's caused by things like high inflation, rising interest rates, bad policies. And in this specific case, it's the Trump tariffs and the sprinkling of the GNU instability that's currently ongoing. Now, Trump's tariffs is basically a tax on all imported goods coming into the United States. Trump is basically saying, hey, China, or whoever else wants to sell their goods in the US, you're going to have to pay us to access this market. Great plan for America. Could possibly bring jobs back home that they lost to previously cheaper manufacturing areas in the world. So factories could fire up if more jobs are in demand. But the downside on that is when you start taxing everything immediately, and the immediate effect of these tariffs is that the cost of these goods and services will go up. Trading partners start getting moody, and if you look at the economic environment now, that's exactly what's happening. And next thing you know, the markets start panicking like somebody spotted a lion in Sandton. Now, the South African economy relies on trade as well. So when big players go to war, emerging markets like South Africa catch the flu. Our currency gets wobbly. In fact, before recording this video, the rand was sitting at 19 rand 29 cents to the dollar, almost a rand up from where it was this time last week. Exports will start to slow down and investors start running for cover faster than a ref at Loftus. So all this tariff drama brings uncertainty, and the markets hate uncertainty. When investors don't know what's coming next, they sell off. And boom, we are in a bear market. Stocks go down, retirement funds start losing money, and suddenly everybody starts acting like the end is near. Even Pete is Googling how to invest in Krugerrands. But you, the savvy investor, are in it for the long haul. This bear market is just a pothole. It's annoying. Maybe it's costly, but it's not the end of the road. What do smart investors do in the bear market? Firstly, we don't panic. We don't make emotional decisions. We think logically. We don't sell everything. And we certainly don't take advice from a random YouTube video online. Although I am a fit and proper South African financial advisor, the content of this video is not financial advice. If you want to understand how this bear markets and possible recession is going to affect your investments, please book an appointment and I can give you one-on-one guidance that's unique to your situation, and so you'll understand what your next move needs to be. Click the link where you're watching this video and book your complimentary appointment. So smart investors ride it out. Maybe you rebalance. Maybe you buy more while it's cheap. That's always sounding like a good idea. It's kind of like buying bribe packs during a Black Friday sale. Bear markets don't last forever. It just tests whether you've got the stomach for being a real investor. So let me share what you should be considering as an aggressive, moderate, or conservative investor. So my adrenaline junkies, the aggressive investor. You see this market dip and you're like, yep, time to buy more. You love the growth stocks, crypto, tech, healthcare. You love it. This is what the aggressive investor needs to be thinking. Buy at the dip, I'm somebody who's buying on the way down and will buy at the dip as well. Big into the tech space, AI space. Exploring emerging markets, if you haven't done so already, is a great opportunity during this point. Emerging markets are cheap. In fact, when Trump announced his tariffs, Vietnam was one on the list and they were hit with a 60 some odd percent tariff. And now they have come to the negotiating table with the United States. In fact, when Trump announced this on Truth Social, Nike, who has a huge manufacturing plants over in Vietnam, their shares soared because the negotiation is to drop tariffs from the US to zero, and the US will then drop the Vietnam tariffs to zero as well. All right, so there is a workaround to the tariffs from Trump. The politicians need to sit down and work with the Trump administration because good can come off this. Next thing an aggressive investor would do is look at thematic ETFs and unit trusts, especially if you don't know how to pick your shares. Just remember, as an aggressive investor, you can't put all your chakalaka in one tin. Recessions don't care about your aggressive confidence. They can kick you in the portfolio as well. So the middle of the road crowd, the biltong with no chili folks. You want the returns, but you don't want to pop a blood vessel watching the markets go up and down. You're looking for a 60-30-10 portfolio. Some local equity, some global exposure, maybe some alternatives or property. Even a little bit of cash for when Eskom pulls a fast one and you need to upgrade your inverter. So your move as a moderate investor, you're looking for about 60% of equity, 30% of bonds, and 10% of either alternatives or property. You should stick to dividend-paying stocks or even dividend-paying unit trusts and ETFs. So you're looking for those big established companies that people are buying from even during the bad times. Things like healthcare, things like grocery staples, defensive sectors such as the big grocery chain in South Africa, right? These areas will still be making money even during bad times because people need to eat. In South Africa, we don't stop spending. We just downgrade from Woolworths to Checkers. Then cost averaging is also your friend because you're constantly putting money in the market at different times. All right, so it kind of smooths up your ride when things start picking up. Lastly, my cautious comrades, the ones that flinch when the rand drops. I hate to be in your shoes if you're that cautious today. You don't want the thrills, you only want peace of mind. You're the type who checks the gate twice at night before going to bed. For you, it's all about fixed income. You like good, constant income, interest-based. You're looking at bonds, corporate bonds, government bonds, good old cash on the money market if you need to, even if it means you are losing buying power in that money due to inflation. You're happy because you don't have the topsy-turvy of an aggressive, volatile market exposure. Maybe you can even throw in some gold in there, not the wedding ring type. It's more the one that shines when everything else tanks. Capital guarantee investments are really great for you as well. In fact, we have a nice capital guarantee that's open until the end of April 2025, where you can have exposure to the US market, US stocks, US tech, US bonds, right? Have your money guaranteed, meaning you're not taking any loss and you have unlimited upside potential. If that's a sweet deal for you, click the link where you're watching this video. We can talk about it and see if it'll fit into your financial plan. Remember, this is a limited time investment. And even if you're watching this when the time has passed, as an independent advisor that works with boutique asset managers, we have this sort of thing happening all the time. You just need to reach out and find out what's the special we have at this time. As a cautious investor, you need to avoid the speculative investments. Peace of mind is your tag. So recessions and bear markets come and go, but your goals, they stay the same. The best thing that you can do is invest for your risk profile. Stay diversified and don't make any emotional decisions. Be logical at this time. So whether you're throwing cash at tech or hiding it in your sofa, in your private game reserve, the key is to have a plan. Don't panic. Panic is for amateurs and politicians. Stay the course. Chat to your financial advisor. If you don't have a financial advisor, I'll be happy to help you. And remember, booms follow busts like Malema follows drama. So let me know in the comments what type of investor you are. And don't forget to like and share this video. Be sure to also subscribe to this channel so you never miss the next video that's coming out on finance from a South African perspective.